think we left off our investment update. So, Mr. Fleming, welcome. Good to see you, Patrick.
Thank you, Mr. Chairman, members of the committee. My name is Patrick Fleming. I'm the CIO for the Treasurer's Office. I would like to comment on things that were asked through the morning session, just to make sure everyone is on the same page on the conversations that we had. First of all, the question on whether or not we would be potentially downgraded. When the stable token bill was passed, I sent that to S&P to just ask them if this would have any impact on our state rating. And at the same time, I just said, is there anything going on that you could see that would impact with what's happening? Because this was a conversation that the treasurer had mentioned to me. And they said, no, not at all. The main components, as the treasurer mentioned, was the deficit and the dependence on minerals. And so nothing has changed on that. So as far as with what's happening with our office, is there anything out there that would be, that is a no. They mentioned there's nothing out there. So I just wanted to clarify that.
It's our environmental social score, is that what you're telling me?
Well, that was the other conversation is they said yes, but I do want to talk to you about the ESG. And as you know, we had it's a score of 1 to 5. And on the E and S component, we were, or the S and the G, the E part of it, we were a 4, along with Alaska. And we were the only 2 states that had that lowest rating. So it really won't impact us because it's primarily for municipal bond buyers.
Did you try to educate them and tell them how environmentally friendly we are?
Yeah, that's, yeah.
Greatest state in the nation.
But the other part of it is the transparency. We did get a 2 on that because we are the most transparent fund in the United States. So that was one thing that, they did talk about our transparency and so forth. So it wasn't all bad.
But we're transparent about it.
Exactly.
Okay, fair enough. Fair enough.
So, Mr. Chairman, the next point before I get into the conversation was the in-kind transfers. And I just want to make sure that everyone understands what was happening and what we were looking at when we started to do these. So right now, I just checked to see what the bid-offer spread was. And obviously, with the volatility that we're seeing right now, we're seeing tremendous volatility. It's the highest volatility in both bonds and equities. Top decile in 1, 3, 5, 7, 10, 15, 20 years right now. So when that happens, you get a wide bid-offer spread. So when we go through and make a change, whether it's a quarterly rebalance or we do an asset allocation change, we would have to change the allocations from all of these funds that we have. So what we did is we said, okay, well, Fund A needs to sell and Fund B needs to buy. And so that's what the internal transfer was. Otherwise, we have to go to the manager and say, bid on 100 million of these bonds, and the next day come back and say, offer 100 million of these bonds, or maybe it's 90 or what have you. And that's the bid-offer spread. Right now, in illiquid bonds, the bid-offer spread is just one bond that we had owned was 2.5%. Now that's not counting the movement in the market. So today, we're down almost 4% on the stock market. If we would have done this yesterday, bought and then had to sell today, not only would we have lost the 2-odd%, what we would have lost another 4%. It's a significant amount of money. So on 100 million, just say it's 1%. That's $1 million that we would lose. $1 million. It was ridiculous just because of these crazy things that we were looking at. I don't care if it's 100,000, a million. I mean, that's just not how we operate. We try to save the state as much money as possible on that. So this year, when it was the first time we found out about the in-kind transfers and the problems, as you know from the previous meeting that we had, we said, hey, we had to get down to the bottom of this. But this will cost the state a lot of money, and there's no way around it. The other side of it is when we're doing the in-kind transfers, now that we can't do them, our allocations will be off because we cannot physically sell a private. So let's say you're a private equity, one of the funds has private equity and they have too much private equity and we say, okay, we need to move that. We can no longer move that allocation because we can't do the in-kind transfers. We physically can't sell. We're locked up to 10, 13 years on some of these things. So right now, if you look at our allocation that we're supposed to have, there's a minimum and a maximum. And we're off on many of them because we physically cannot sell those securities. There might be a 3, 6, 12-month delay or what have you. So just so you understand, obviously this caused a lot of problems, and obviously we never would have done it if we would have known it, but the reason for doing it is a significant reason. And getting back to the previous conversations that we had, we're the only state that does this. I've talked to they have one fund, and they don't have this issue. Or if we would have passed the constitutional amendment, it wouldn't have been a problem. But anyway, we deal with what we have to deal with, but this isn't just something that said, oh, this makes a good idea. No, it was done for a significant reason. I just want to make sure everyone understands that.
Go ahead.
Thank you, Mr. Chairman. So if you had your way, you'd still do in-kinds for all the reasons that you've stated. Am I understanding that correctly?
Mr. Chairman, Representative Obermuller, absolutely. In the previous conversation that we had here, when it was, they used the term that MHP was looking at this that it was their interpretation. It wasn't their interpretation in previous meetings that we found out. It's like, no, it is an accounting rule. You have to have a legal entity buy and a legal entity sell. So if we could make every one of these funds be a legal entity and would be fine and do that. It would cause us to have about 600 funds. That alone would cost, over $4 or $5 million at JP Morgan. So could we do this? Yes, but it would be cost prohibitive. We've looked at so many different alternatives that there's many, and we're still looking at them, but it's a problem. The structure that we have is problematic. We talked about the issues that we have and how many funds that we've grown. So you look at it and you go, wow, we just have all these new managers. Why is that? Well, just think of all the different funds. When I started here, I was the only person managing the 19 billion. And look at the fund structure that we had. We didn't have Pool A. We didn't have WildStar 2. We didn't have the Tomorrow Fund. We didn't have the Mineral Fund. And all the other funds like Common School. Common School wasn't an income-focused fund. The PMTF didn't have the total rate of return. We were 55% maximum equities. When I first joined, we presented to you the issues when Treasurer Gordon, and we had an outside consultant, and we talked about the issues that we had at that time. And it was an accident waiting to happen, but we knew, the growth of the funds and what we were doing, it was problematic. And the way that the fund is structured with all of these different funds, instead of just having one fund, or like in the constitutional amendment, it is extremely difficult. When I meet with all the other sovereign wealth funds, we have a quarterly meeting. And one meeting they said, well, how many funds do you manage? And we said, well, we have, 12 different funds, but then state agency pool is, like 400 accounts or whatever. And they're like, you got to be kidding me. And every one of them, except I think one or two, had one. And they take all the money, they put it into one fund, and they distribute it. So, issues happen or what have you, and it is what it is. But the magnitude of the changes that was required by the different funds that were implemented from the legislature and the SLIB and the IFC has been significant. It has been a massive endeavor to try and get all of those funds with limited systems, people, processes. We do a trade to this point, and I have to physically write out a ticket and put that in. In 1993, that's when we went to automation in New York. We used to write tickets. 1993 is when it was all automated. So, that I'm not making excuses or what have you, but I just want to let you know that the issues that our accounting and our investment staff face because of our structure is significant. So I just want to, before we had all these comments, I just want to make sure that everyone is aware of some of the things that we have to deal with.
Yeah, Mr. Chairman, are we headed in a direction where we have a tail wagging the dog situation where you're doing things that you wouldn't otherwise do because of constraints in the accounting department?
Mr. Chairman, Representative, it's not only the accounting department, but just as what we were talking about with Representative Hallahan, and we've talked with Representative Harshman and so forth. We have so many things where the tail is wagging the dog. Just look at the instance of the PMTF versus Common School. That is the tail wagging the dog. That we have to have income to meet the Common School over 5 years. That's over $250 million we missed out on. Because we have to have income to support Common School because of our definition of income. So as you can tell, it's,
How do you really feel about it, Patrick?
no, I just want to make sure everyone understands, Mr. Chairman, that this just didn't materialize a year ago. This has been going on since I came here. And the first time I got here, Treasurer Gordon, I said, we have to get a consultant in here because this is a mess. This is going to be a problem. And we presented at that time, and we still have the write-up in the presentation. And it was just a matter of time when things would happen, when something would go wrong, and it happened to be in-kind transfers. But we were doing it for all the right reasons. It just happened. We were trying to help and benefit the people of Wyoming. But with our structure, it is problematic.
All right, thank you.
Go ahead. President.
Just for my edification, so we're talking about higher education endowments. It's not all the different assets that are allocated and distributed. It's that account, Common School Permanent Land Fund, Hathaway. Those are when you talk about accounts, are those the accounts, or is it, say, within the agency pool, each agency has their own little account within that? So just for clarification, what are you specifically, is it the big trust funds, or is it subcategories within the trust?
Mr. Chairman, Senator, again, both.
Well,
So as you all know, in state agency pool, we had assets in there that could go down, primarily emerging market debts. Those accounts do not have an offset. You had to go a negative cash balance. You couldn't do that. So what did we do? We put it into a ladder strategy. So those are instances where we will not have a realized loss in that account. So that was something that we had to change. Now, the other accounts that you alluded to or mentioned would then be the main accounts, the PMTF, Common School, higher ed, and so forth. Each one of those didn't have to be, but they were set up improperly. For instance, workers' compensation. It has a liability of around 12 years, and yet our assets that we had invested in that were about 6. It made no sense. You have to tenor match those. That was another change that we had to do. New managers. We had to have it's liability-driven investment, LDI strategy for the workers' comp. The amount, you can go through every one of the funds. We've had to restructure each one of these funds primarily, whether it's because we went from the 55% mandatory equity exposure to the 70, moving how we move that, teach each sub component of it. So the accounts you're referring to, it's across the board. It's been a major lift.
so Mr. Chairman, a follow-up, Patrick, you alluded to the fact that constitutional amendment would resolve part of that, but that only dealt with Common School Permanent Land, PMPF. So you still have Pool A, agency pool, all these higher education endowment, Hathaway. So you're still, even if that constitutional amendment would have passed, we'd have still had great complexity in our system.
Mr. Chairman, Senator, yes, but we could have collapsed that in a big deal. What we could have done is taken all of the funds that have a total rate of return type of long-term mix and combined those. And then we could have taken like the LISRA, Pool A, cash, and short-term investments. And so we could have dramatically shrunk the pool to basically 4 funds.
So, Mr. Co-Chair,
Go ahead.
so Patrick, I think this is one of the most important issues that we're going to be talking about in CapFin through the rest of this interim. And what we're talking about is collapsing or going to one fund or funds or 3 funds, whatever we can do and how we can do it. So as you proceed through, I think, in your presentation today and going forward, you need to continue to remind us how that works, how we would do it, and what the process is to get there, in your mind. The constitutional amendment is a good example. We had folks literally lobbying against it, who didn't really understand what it was doing and how it worked. And so part of that was our fault. So we need to be better educated on it so we can educate others and have you help educate. I mean, 'cause basically it doesn't, there's a component about having one legislature telling another legislator what the law is or how it works versus having you say it, because they believe you, they don't believe me. And so we have to work on that. And so as you present, I want to continue to have you remind us of this as we go forward, and your ideas of how we can go to 1-1. And then on top of that, and as we go, you heard it a little bit this morning, is we got to have complete confidence that how we're managing our dollars is successful and profitable for us, so we can better articulate that message, and so we can do the homework and say, look, don't trust us, trust the documents, here's the information. So all those things, I think, rolled into one on where our future lies, in addition to where we are now, and to help us better understand it. So,
Mr. Chairman, Mr. Vice Chairman, this is something that the treasurer and deputy treasurer, we've been working on this, for a while. This is something that, what could we potentially do for this? So yes, thank you. We will do that. But this is something that our staff, and then the treasurer and other people have been working on for some time. So hopefully we can do something to fix some of these situations. Next one, real quick, is Mr. Vice Chairman's comments about the internal trading and also how that impacted in-kind transfers. There was no impact whatsoever. It's really apples and oranges. The in-kind transfers had nothing to do with internal management. In fact, internal management has helped in certain instances. As far as I know, that JP Morgan has all of our securities. If we buy a bond or a stock or whatever, they know what the realized gain is, the interest income, and so forth. It's not until it gets into the managers that's an issue. So saying that there's any relationship to internal trading and in-kind transfers, there's nothing to relate the two. In fact, the in-kind, when we did the internal trading, for instance, in the state agency pool with the ladder, that alleviated that issue, because when we control the buy and the sell, we will never buy or sell a bond that has a realized loss. So we can control that issue. So those are other issues with the internal trading that I want to address as well. So with that, do you want to proceed into the returns and also the?
Yes, please, unless somebody else has another question they'd like to ask. All right, please.
So I will be speaking from the return monthly investment performance from RBK. And one thing before we start, I just want to highlight RBK. I just can't speak enough about what they do, but don't take my word for it. Here, they received the top notch again for the 5th consecutive year in a row from Greenwich Associates. And this is, I participate in the survey, and it's in-depth survey. They call all the managers, and again, RBK was the top dog. So I just want to highlight all of the great work that they do. If you turn to page 5, we've talked about this before, and it's really coming through right now, but you're seeing on page 5, that's called the Quilt Chart, and it's a very busy chart. But again, it highlights the issues that we face on a forward basis as far as our primary objective, which is the risk-adjusted return. So if you look at it, without getting into too much detail, the returns that we're expecting, again, the risk-adjusted return, which is primarily a Sharpe ratio, is what is used to look at that. And all that is the return divided by the volatility. And as I mentioned, volatility is off the charts. Volatility is increasing. So that would reduce, excuse me, your risk-adjusted return on this. But as you can see, if you look at the private equity, for instance, over the last 06 to 22 period, you had a Sharpe ratio of 1.11. That is very good. Anything around one Sharpe is very good. Now look at the 10-year forward forecasted by just about all of the forecasters. That drops down to 0.24. It's a significant deterioration, and that's what we're faced with if these forecasts are correct. Volatility is going up, return expectations are going down. A 60-40 portfolio over the last 50 years has returned a 5% real return. This is forecasting RVK's capital market assumptions this year is returning 1.2% real. That's what they're thinking the next 10 plus years will be. And whether it's 1.2, 1 year, 3 years, what have you, a longer term, we're just facing a more difficult environment from what we've seen over the last few years. Next part is moving on to performance.
Go ahead.
I have a question on that. So we made the assumption that was correct, plus or minus that. How does that affect our spending policies? Those type of returns?
Mr. Chairman, Senator, yes. So if let's just say they're correct in the 1.2. Real. The forecasted inflation on that is 2.5 over that same period. So we're 3.7 on that, on a nominal basis. Our spending policy is 5 in common school, as you know, and 2.5 plus the other SIP and LISRO, what have you. So that would say that no, we are not going to meet the spending policies, much less to grow the fund on an intergenerational equity basis. And that's part of the reason why we're moving. And the IFC, the treasurer, the IFC, the SLIB board, they've done a great job in changing the allocations that we've had and moving it to the reference portfolio and all these things to at least allow us to be in the game to meet these things. Because if we just did a 60-40 portfolio, there is no way. So what have we done? Well, we're not doing 60-40 public markets. We're doing more of a 70-30 public, private credit, and so forth. So with the asset allocation mix that we have now, we would argue that we will be able to hit those spending policies, but I'm not sure about after inflation. That would be more problematic.
Mr. Chairman, follow up on that. We're now doing our asset allocation portfolio and we our spending policy is. And my recollection part of that conversation with the constitutional amendment was to try to get away from letting the spending policy drive the asset allocation. Am I wrong in that, or did I miss something along the way?
Mr. Chairman, Senator, no, that is not how we do it. We look for the highest risk-adjusted return. What are the asset classes that perform the best over long periods? Okay. And so that is something. If you say, hey, I need a 10% return, let's do that. That's where you blow up. You can only take what the market gives. And that is an important part of what we're trying to do, is saying, what is the value out there? And as we go into some of these things, the numbers will bear that out and show you that so far it has worked. And we'll see, especially during these volatile times, whether or not our asset allocation and manager selection and internal investments has worked. And I'll be addressing that in the next few slides.
So just real quick, so the 70-30 is equities versus fixed income?
Mr. Chairman, Senator, there's a couple different definitions. The way that RVK uses a 70-30 portfolio, they use what's called the ACWI, the All Country World Index. So that's global US equities. It's primarily 50% US and 50% international. And then 30% what's called the Bloomberg Barclay Aggregate, which is the bond index that most people follow. And that is the 70-30 portfolio. Other people will just use a US portfolio and just say, the 60-40 is typically known as a US portfolio.
So, but what you're doing there, if I remember right, is what you're trying to do is you take the risk associated with that portfolio. That's not necessarily the portfolio you're striving for. You take the risk-adjusted rate of return that you anticipate for that portfolio, and that's what you're trying. That's what sets the upper limit. It's not whether you're 70-30.
Mr. Chairman, that is, well, we take the 70-30, and that was a wonderful thing that the legislature, again, all of these things that you are allowing us to do have been wonderful. So I don't want to come across and say, oh, what are we doing? What are we doing? The changes that we've done are significant. But just that as an example, instead of looking at a 70-30 portfolio that is 70% equities and 30% bonds, I have been here before this committee and I said, the risk on the bond portfolio, 30-year bond is a heck of a lot more risky than equity, in my opinion. And that is exactly what you allowed us to do, to use a reference portfolio of saying, well, let's not call it a bond or a stock or whatever. Let's just see what the risk is and associate the portfolio with a risk-adjusted return. And that is going to allow us, again, to try and hit those spending policies in a much more, up-to-date, real way of doing business. That's how, if you look at hedge funds or any, sophisticated funds, they don't give you a 70-30 stock portfolio. They look at your VAR, your value at risk. That's how things are calculated.
Jim,
Go ahead.
just real quick, just you mentioned generational equity and that risk-adjusted return. And I just think back to when we met, I think we met in December here last, and we kind of looked at some of that long-term. We've done really well. I mean, when you say that though, that doesn't count the deposits that go into this. Is that right? And is there anything else we need to know? I mean, most of these funds are just trying to grow the fund. We're growing the fund deposits. Comments on that? Thank you, Mr. Chairman.
Mr. Chairman, Representative, yes, absolutely. So when you look at it without the FMRs, then it has not met the intergenerational equity. And Representative Harshman and I, we did a study on it and went back and looked at it. I know LSO has done the study as well. But by doing that has worked. And obviously, the war is terrible and what's happening is horrific. But for Wyoming's total return, the money that we are getting from $100 crude and 7 to 8 natural gas is significant. So that has been beneficial in that sense. So those are the things that what I'm referring to is the fund alone, intergenerational equity, and not including FMR. So that is a very good point I should have mentioned.
Okay, thank you.
So, Mr. Co-Chair,
Go ahead, Mr. Vice Chair.
one thing I forgot to ask that you address as you move along, because you've talked about this with us before, but I think we need to get better educated on it, is, I mean, in some ways, we've tied the hands of your office on certain things you can and can't do in terms of what and how you can invest. So if you can, as you move along, remind us of what things we can do statutorily or otherwise to give you the full toolbox to do what you need to do to provide the returns that we'd like to get. So we're not going to only make 1.2%.
Mr. Chair, Ms. Vice Chair, in what you have done and what you're doing, I think is significant. What we're doing right now, you really care what we're trying to do. Just trying to pass that constitutional amendment, that was significant. I mean, that, Treasurer and I have had numerous conversations. The most important thing is if we could get that passed, what that would do to our ability to change. So though you are doing them, and what this meeting and the subsequent meetings that we have, you're focusing on those. The one thing that I would comment on is our structure. And you've heard from, I don't know how many people here today, that we're unique. No one else does it like this. It is a complicated problem. And every year, you put additional funds, the Tomorrow Fund, the mineral, you continue to put additional layers on top of this. So it is what it is, and I'm not complaining. You say jump and I'll say how high, but you have to realize that the structure that has been put in place is extremely problematic for some of the things that we're doing. And today's conversation with our accounting and our investments are case in point.
Go ahead.
Thank you, Mr. Chairman. Would a straight endowment model be the best model for investment purposes?
Mr. Chairman, Representative, if you look at the historical returns, endowment models have outperformed other funds. The issue with that is their funds are not inviolate. So you could be chock full of private. You could have 80% of private equity, which has the highest return, if you will. And if the market goes down, so be it. You can just liquidate and pay it. We have, which I would, as a Wyomingite, third generation Wyomingite, I would say, no way. You want to have inviolate funds to protect our future generation. So yes, the endowment model works. It has a higher return, but there are also significantly more risks associated with an endowment model versus our funds.
Mr. Chairman, why, kind of flesh that out a little bit for me. Why would you want to hold on to an inviolate fund model when it's not the best model for returns?
Mr. Chairman, Representative, because of the structure that we have, so for instance, I'll give you a case in point. In the great financial crisis, Columbia University was striving to get a higher return. So they had a significant amount of private assets. When the crash hit, they have to spend to support the school. They were selling private investments at 50 cents on the dollar to try and fund those. So yes, if my answer was yes, if you're looking at the total return, but it comes with significant amount of risks. Are we willing to lose 50% of the entire fund and not be able to make a spending policy that is mandated? You're not able to do that under the current rules. So if you wanted to change the rules and say there is no spending policy or increase the reserve accounts so we were able to do more, then that would free up some of the things that we could do. But right now with the current structure that we have, and I've just seen too many markets over my lifetime that everyone's the Pavlovian response is when we have a sell-off, it has a V-shaped recovery, and we're all back to normal in a year or two. But I was in Tokyo in 1989. The Nikkei peaked out at 38,600, and we're not even 2/3 of the way through. 29 to 54, 25 years, and that's not even on after inflation adjusted. It took 25 years. The Nifty 50 took 8 years. The dot-com bubble was 14 years. So it doesn't necessarily always just V-shaped bounce back. There are times when you have prolonged periods. If that happened, we would then not be able to fulfill the spending policy and have the returns that we would need to operate the state.
Mr. Chairman, when you talk about building bigger reserve accounts in order to mitigate impacts on the permanent funds, doesn't that work against the idea of consolidating funds for better returns and having things in one pool for investment purposes?
Mr. Chairman, Representative, that's a great question, because that is exactly what the combination would do. Is if we had one fund, you wouldn't need a reserve account. You might have the reserve accounts just to help in the near term or what have you, kind of, the little sidebars to help you along in case there was a sell-off. But in that instance, as long as the market value versus the cost value was above, you would be able to spend that money. So it would negate many of those needs.
Okay, thank you.
So, but to follow up on that point, I mean, the other point of that is without the single fund that would have been allowed by the constitutional amendment, the other side of that coin is the next best thing is that you increase the size of the way I understood it was you increase the size of your reserves account, because if you've got, we were looking at, we were trying to have like 3 years of reserves in our accounts. But if you move that up to where you're having like 7, 6, or I can't remember what state we looked at, but if you had a 7 or 8 year reserve, then because you've got your reserve is that large, you basically you can invest the reserves just the same way that you do the underlying fund.
Mr. Chairman, that is correct. And the academics would tell you 5 years. If you have 5 years of a spend, then you would be able to do that. And it's not only the spend, but getting back to the FMRs, you would say, well, it's not only this, but what kind of income historically, even if oil goes down to $30, how much would we be able to get to support that? So if you had that, then you do away with the reserve account, or you could take the reserve, you don't do away with them. You take the reserve account and put them into the same asset mix that you have in your regular fund. So instead of having $300 million sitting there earning 80 basis points, you would have a total rate of return fund.
$1 billion making the same as the underlying.
Absolutely.
Yeah.
And then all of those various funds, and if you did away with all of these, the reason that the treasurer mentioned the 17 to 23 firms we interviewed to find out a new accounting system, just as he said, they're like, you know, but Pat Arp, the treasurer, Gordon at the time, we sat in this meeting, they were like, oh, yes, we can do that. Okay, now here's how we do distributions. The first 25 goes over here, and then the next 25 goes to this fund, but if this fund's full, then it's gonna tip into that. End of story. Nope, can't do it. And they walked out. Every single one.
Oh, have a little fun up here. Okay. Oh, did you want rebuttal, Perry? You want rebuttal to that side remark? Okay. Okay, go ahead.
Go out live, by the way.
His mic wasn't on, so you may have to have him restate it for the record.
Yeah. Mr. Chairman, so the issue is we're not gonna have an inviolate. Politically, it would never fly. I don't know if I would support it. You know, but the part is, we have now a reserve account, doing a visual, and you have this gigantic permanent fund. And the idea then is put them in together, and then there's an accounting line in between, merely an accounting line. And I think we can go in and define what is inviolate. I mean, are the 1% statutories inviolate? I think you know, and I know there's some constitutional wiggle on this, but I think that's the issue. And we go in and say, this is it. And these future deposits are all on this side of the accounting line. But it's all in the same investment box. That's the way I see this. And I first saw that, my friend here from Casper, Representative Obermiller, really. And so we're all talking the same thing. That's what we had in these constitutional amendments. You know, we're sitting here talking hindsight, we probably should have had a little education seminar down in the auditorium, you know, and you take everybody through there or something, but it's just, so it's gonna be inviolate, but the size of the reserve's gotta get bigger, and the reserve is in the big pot. That's it. I mean, that's how I see it, and say it simply to people. Anything you add to that, or?
Mr. Chairman, Representative, I think in the previous conversations that we'd have, the gentleman to your right would be the person that you need to convince on that one.
Yeah. I think, in fact, I think Representative Ogby did want some rebuttal time as well. Go ahead.
No, but in joking aside, yes, if there are numerous things that we could do in light of it not doing a constitutional amendment that potentially could change how we do things. But I think the number one component of it would be a massive legislative change to change all of the distributions that you do currently. And we have just started, the treasurer has asked us to say, you know, what are some of the things we could potentially do? And our staff, we've whiteboarded it, looked at it, and we're in the first inning of doing it. So it's way too premature for us to comment on that without having all the facts. I don't have the facts, but the treasurer has been all over this and has been looking at potential ways that we could improve what we're doing now without a constitutional amendment.
Go ahead, Representative Ogby.
Thank you, Mr. Chairman. This isn't a topic for today. I just want to tee it up. And that is that at some point we need to come to an understanding of what inviolate means. And I've seen some modeling done that was indicating that part of this endowment-like structure that we were talking about building would allow us to sell a loss asset and harvest all the money, including the basis of that money, and with the idea that somehow inviolate could be defined in terms of the value of the fund rather than the cost basis of the fund. So at some point we need to have some clear definitions of what your office actually believes they can do under a structure had that bill passed to restructure it.
Mr. Chairman, Representative, the mandate that we're following right now, and that has been in place for many years, is the Meyer rule, then Treasurer Joe Meyer, who instituted the rule, and that has been put in place. But under that rule, the cost basis, if you're buying something at 100 and it drops below 100, then you're not able to distribute the realized gains under that structure. That is the definition that we're following at this time, is the Meyer rule.
Mr. Chairman, just one follow-up on that. On the modeling that's been done on Senate File 121 as a potential model. That was modeled out to demonstrate that, that the basis of a loss asset could be sold and that the basis could be distributed. So that's what I was just forward looking in terms of how the definitions of inviolate would change if we moved forward with endowment-like model. Thank you, Mr. Chairman. That's all I had.
Mr. Chairman, Representative, no, that is a great point, and that would need to be spelled out. There were some people who are saying that you should not have an inviolate structure and other people who would, but if you are going to do a constitutional amendment, then, you know, the world is your oyster and you do what you want to do and see what happens to pass it, but you could structure it any way that you would want. All I'm referring to is how we do it now.
Okay, thank you. Keep going.
Thank you, Mr. Chairman. So one thing, before I get into the performance, the conversations about the internal trading and so forth, and there are certain people, highly intelligent, smart people on our IFC who just do not believe that we should be doing internal trading. The way I look at it is I'm just a dollars and cents guy. I think to me it is extremely black and white. That's one thing about this job. You're either making money or you're not. And every day, every quarter, every month, what we're going to go over, you'll see whether we make money or not. And so if we go back and we look at it and say, well, has this been successful or not? Then to me, I don't understand that counter argument that this is not a successful program if we have historically been able to produce alpha. Alpha is the return above the benchmark. The asset allocation is done by the IFC and the SLIB, and our main job is to produce alpha. And we do that by internal trading, our manager's performance, and also our tweaks to the stated benchmarks that we have. We can under and overweight to a certain extent. So those are the tools in our toolbox that we do it. And every year that I've been here, I've come before you and I show you fund by fund by fund, whether you're making money or losing it. So to me, that argument is problematic if you can historically prove that you have made money. So the longest fund that we have is the internal fixed income investment. I've been doing that for 7 years. So that has produced a 30, you can look at the returns in here and look at our internal funds, and it's produced 30 basis points over the index for 7 years. PIMCO, who is one of the best bond fund managers, I think they're like 20 or something. So we have demonstrated over time that we can produce income. That equates, so you're saying 30, 4.5, 7, 21, 31, almost $32 million in additional income to the state if we would have indexed it, or less if we would have put it in PIMCO or what have you. But to me, this is a very black and white argument on whether or not internal investments make sense. The other side of this that many people don't realize is that when you do the trading yourself, you are focusing on the market 100%. That's all you do. And you see things that happen, and part of the previous conversations that we've had is the changes of the asset managers that we've had. So you've heard me say this for many years, that there are issues in the market with valuations and so forth. And so what we did is we went out and found managers, as the treasurer mentioned previously, that did very well in a down market because the market prices were extremely expensive. We said, well, as long as they can stay on par in an up market, which they did last year, hopefully on the downside, they will be able to lose less. And that is so far what we've been able to do. And we went out specifically, and there were some managers in our portfolio that had like a 1.2 beta. So if the market goes up, they're going to outperform by 20%. Market goes down, they underperform by 20%. But we all know that the majority of the time the market goes up. So it's a great business model. You could just lock in 1.2 beta, and 70% of the time you're going to outperform your benchmark. That's not how we do it. We look at it and say, well, no, we don't care. We want somebody who can stay with the market in expensive times, but who will then lose less in a down market. So like I said, this is real life example. I mean, last I looked, the S&P was down another 4% today. These are the times that we're going to see whether or not this worked. And we're just seeing preliminary now, some of our managers that we thought, PIMCO short duration fund, they're down 63 basis points. That's, for a short fund, that's a lot. We were like, well, what happened? So whether it's internal or external, you're not always going to make money, but we have a portfolio set that should do well in this environment. And that's some of the, which I would like to talk about now. So if we can go to page 7. Just the total fund. If you can see over the current year to date, now this is March numbers. So just so you know, if you remember looking at the S&P peaked at the end of December, we traded down, we rallied back up into only being down 5% at the end of March. And since we were down 15 odd this morning, at another 4, we're down like 19% now, year to date. So the March numbers really do not reflect as much carnage that has happened in the last, since April 1st and on. And I can highlight that. So here we are, the total fund, which has like the LISRA and all these different things in here that we just have benchmarks and so forth. It really isn't indicative of what we're doing across all of those sub-funds that I was referring to. So if you could turn to page 8. This is where the real important part is in highlighting what we talked about. So page 8, if you look at it, so the PMTF was minus 1.6, but look at the 70-30, it was down 5.5. That is case in point of what the asset allocation that the IFC and the SLIB has done and what we've done on internal management to not lose as much when the market goes down. And so I just want to give kudos to both of those groups for the hard work that they've done in putting together these allocations with RVK. So financial year to date, just so you know, this morning, last night's number, that 70-30 portfolio for the financial year to date was minus 13.6%. So these are the things that we're talking about, that if the market continues the way it's going, which we're heavily oversold and we should get a bounce. This is way oversold. But if we continue on this, we're going to have significant losses. But I'm very confident and hopeful it's not going to be as bad as that 70-30 portfolio because of the structure that we put through. And that's the real key to understanding what we've done and all of the problems that we've had over this period, which we all talked about this morning. But this is the benefit of what has happened, that we're able to put together a portfolio that should outperform in a down market when things are really poor, and in an up market we will be able to do better than the majority of the other individual or sovereign funds out there. So I don't want to sound dour, because I really am excited about what the Treasurer has done, the SLIB has done, the IFC has done in changing the way that we do our asset allocation. And we will see the next June 30 when we report again, if this market stays here, we'll see how we've done. And it's terrible that we lose money, but in these environments, losing less is really critical. So, Mr. Vice Chairman, do you want me to continue on with the various funds, or just, I just wanted to highlight, I could go through each one of the funds and talk about all of them, or if you would like, we could move on to your request of what all the funds have done, and I can comment on those.
Yeah, I think we highlight would work fine unless everyone, yeah. Go ahead, please proceed.
Okay, so I'll be speaking from the handout that we have. Now this is the part that I talked about. This is the black and white. We either make money or we don't. It's pretty easy. And if our internal funds are losing money, then you would have to look at it and say, well, what is the benefit for having this internal investment if you're losing money? And I would say, even if we were losing a small amount, I'd argue, one, it's helping us with the overall asset allocation, and also the staff. The staff loves what they're doing. If you said, no, we're taking, you're not gonna, all you're gonna do is manage a manager, I don't know what they would all do. I mean, I've gone to these conferences, and people who do not do the active management, 90% of their time, they're just saying, well, I'm gonna put together a fund that will beat the benchmark because we can jigger it this way, and they figure out a fund that beats the benchmark instead of the total return. I don't know, I don't see that people would find that exciting. So in this, fixed income, now this is as of April, so we just did this yesterday to put together these returns. So for instance, PIMCO. This is a very new fund, but you see the PIMCO low duration, the second one, they're down 5 million. And I could show you the returns on the previous pages, but I like showing dollars and cents. If I said, oh, they underperformed by 63 basis points, that really doesn't mean a lot to me. So I'm hoping that looking at this will show you what the funds have done. So, you know, are we going to fire PIMCO because of after 3 months or 6 months of trading, they're down 63? No, there's going to be times when internal trading is down and we can bounce back. I feel confident on that, and I feel very confident that PIMCO will bounce back. YFIP, that is that internal fund that I mentioned that has the 7-year track record. Wyoming Internal Fixed Income Portfolio, we're up 5.4 million so far year to date. You could go through JP Morgan, 11, that's the mortgage-backed securities. Caleb Simpson's short-term duration, another internal fund that he's done a fabulous job on. He's up almost 5 million on that. And then you can just go through each one of these funds. But for the fixed income portfolio, in alpha dollars above our benchmark, we're up $31 million. Now on the equity side, if you look at the Wyoming internal equity, the QM, the quantamental, we're down 5.7 million. And Feng Zhang, who manages this, it's a very short time frame. He's historically, over the last 20 years, produced alpha. And this fund primarily invests in the best ideas from other hedge funds and so forth. So much of these funds would be highly, looking at, we don't have an internal staff to do the analysis on the funds, but there's a lot of like Amazon or Microsoft. Amazon's down 33% year to date. Microsoft's down 50%. These companies are not going away. They're very, very good. But unfortunately, like other funds in this class, they're down. I feel 100% confident that we will make money in this strategy later on. And as you can see in other internals, like his quantamental strategy is up 3.8 million. So it's not all down, net, he's slightly down, but that's an internal manager internal management, which I feel very confident that we will make money over time. So as you can see, each one of these funds, Arrow Street continues to knock it out of the park. They're a black box quantitative international manager. Harvest is an MLP manager. They've had a great year. So the net alpha dollars as of April for the equity is 97 million. And again, having the right, when you do the internal management and you see these other things like Van Berkom is up 12 million. We increased that allocation to Van Berkom because of their structure. We saw some of these things that were happening from our internal portfolio and added money to Van Berkom. We knew that they would do very well in this environment. And as the market goes down, I'm pretty sure that they'll continue to do well. Okay, hedge funds. Matt Smagash, who does the hedge funds, he's down both internal and external on that. B is Grosvenor. So that is Grosvenor's management. They're down 8 million and Matt's down 11.5. His structure is again safe, But with these big funds that have lost a lot of money, the Tiger, some of these funds that have never lost money in their entire existence are down because they were long some of these stocks. I feel very confident that, Matt will be able to come back. But like anything, everything isn't only up. There's up and down. And, this happens to be, another down year, but we feel very confident in his strategy and what he's doing. And, as the treasurer mentioned too, on the private equity side, he's doing extremely well. Grosvenor D. So this is the Opportunistic Fund. This is again an internal fund. So you look at that and say 18 million, but we have two basically, Instacart and Red Mile, a biotech company, and Instacart, which is a home delivery, that have taken it on the chin, and that's causing the loss. Since inception though, we're outperforming the index there by doubling the index. It's one of the best performers. So yes, we've had to give back this year, but if you look on a 2-year basis, it's been the best performing fund versus the index that we own, other than like Arrow Street or something. But as far as a structure, it's been very good. Real estate, Robin has done an excellent job. Some of these things, as you know, it's not like we can trade in and out of real estate. So that one, these are all managers. Obviously, we don't do any internal management. The biggest one is SC Core. That is a non-dollar fund, and you look at it and you say, well, it's 100 million, 112 million market value, and yet they've lost 17 million. A lot of that is the currency. So the dollar has done very well, and we lose on the currency side. So that is an issue, but we have very little non-dollar exposure, and this is one of the areas where we try to get it, because the dollar will not continue to go up forever, and so you want to have a little bit of non-dollar exposure with some of the equities and real estate. So that is for the total alpha performance that we have, and now this is not including the sector bets that we've made. So we're going to be buying back some of our short equities. We're underweight equities. We were underweight fixed income. We bought that back. So far, knock on wood, we should have additional income that we've done on the sector bets, which are not spelled out in this chart. So before I go into the fee discussion, are there any questions about our internal management and external fund managers and their performance?
So, Patrick, my question is, in terms of the size of your office, for, your investment staff, you feel right-sized? Do you think you could benefit by having a few more investment folks to help cover what you're doing? Just outline that.
Yeah, Mr. Chair, Mr. Vice Chair. So right now we have one analyst position open that we're looking to fill, but we're doing something internally that would cause that to be filled. So that from the analyst side, as we move more into more private markets, Matt Smagash, not only is he doing the hedge funds, but he's also doing the private equity. So that is a big draw on his time. So that is a conversation that the IFC and the treasurer has had on and on. Where are certain areas to do that we could do it? So potentially that would be one area. But what we wanted to do first is, with what you have given us, let us see, give us time to see how we do it, and then we'd be able to fill in or ask for additional positions if needed. As far as the internal management, we're only the internal stuff that we're doing is just the low-hanging fruit. It's the equities and U.S. government bonds. I'm not out there buying mortgage-backed securities. It's just the basic things, because we don't have the analysts and internal staff to be able to do that in an effective way. We'd need many, many more people. Now, that is the area that I would say, I don't know if it's worthwhile to do that. I mean, the incremental benefit for doing that, I'm not sure would weigh on that. So I'm not in the position that's saying, oh, we should internally manage this entire thing. We'd need like 200 people like New Zealand or somebody. And that, I'm not saying that at all. But to answer your question, we want to continue doing with what you've given us and to see how we perform. And if there is a need, then we would like to come back and see. But right now, we would really just like to excel at what we're trying to do. That's our focus right now, is with what we have. Let's produce the alpha and see what happens. So the next part is the fees. Now, every year we do this alpha performance and the fees. So last year I mentioned to you that with the asset allocation, as we get into more privates, we increased into the infrastructure, the private credit, the low duration. We had many different funds, real estate, et cetera, et cetera. But if you remember when we started this program in 2016, we were saying at that time, we had 34.7 basis points what we were spending. And we said, well, how much of this, if we can bring this on in-house, then we would be able to expand from the one person at the time that I was managing to what we have now. And so with that, you can see on the AUM adjusted, because we have to adjust it by AUM, because as the fund grows, you can't use the same basis points or the amount. We're still at 17.3 million above where we were on the 2016 basis. But go back to the page, the long page that shows all of the funds. Look at the right side, the difference in fees on three categories. Private equity, from the beginning to now, is 3.5. Real estate, 5.6. Hedge funds, 4.8. So as the IFC and SLIB change the asset mix, and we go from core fixed income, which has a 10 basis point management fee, to, for instance, private equity, which is around 1%, this fee structure will erode and go negative quickly. So as we build this out, we will not have that fee savings because of the asset allocation change. So you can see just over this period, if we didn't have those three, it's around for like 13, 14 million additional savings that we had. But of course, the bottom line is not how much fees that we're paying, but the total return and the alpha production that we're doing. That's the number one thing. So if we're having very negative returns with our alpha and having negative fees, then that would be something that I would question, saying, what is the benefit here? Any questions on our fees? And Senator, as you were mentioning earlier about the structure of the fund, what we were looking at is just the investment staff. But as Don has given you and did a lot of work on looking at what the entire staff in what we're paying, what we paid in the back or historically is around, 4 basis points or what have you, which is, I think scraping the bottom. 4 basis points on the fund, that's $10 million. So even with the fee savings that we have, we're still paying not only for our investment staff, but the entire investment back office, everything else that she has put forth. And, one thing that the treasurer has mentioned, that if you're looking at it and saying, well, what would be a better way to do it? Potentially, his idea of looking at, maybe looking at the alpha production, some moving average or something to do this, because the current structure that we're looking at in savings will not hold true as we do the build out that has been promulgated by the IFC and the SLIB. Does that make sense? As we go into more private markets, fees go up. And we're selling 4 basis point equity type funds to go into private markets. We're selling 10 basis point managers to go into private credit. That will cause us to reduce that fee structure. This will, over time, that number will flip. And I mentioned this last year, and I'm just showing you that it is and will continue to erode. Yes, we are. Yeah, as I said, this, $90 million above, I think, so far that is good. Do we want to make more? Absolutely. But trying to in these markets, these volatile periods, limiting your downside is what we're focusing on and have been for the last year, as you know, from the comments. So, you know, it's tough to lose money, but if we can lose less, that is goal, because we can't liquidate 25 billion and go into cash. So, you know, we have a plan. We're staying the course, and very confident on what the IFC and SLIB and all of you have done for us. And so I want to say thank you. And I apologize if I was ranting beginning on this, but it's just, yeah, our structure costs us a great deal, and I can quantify the numbers that how much it cost us, as we've talked about. And it is what it is, but I just want to make sure that everyone understands this just didn't happen 2 years ago. This has been going on for 7-8 years. Any other questions, Mr. Chairman?
Keep going. You're doing good.
No, Mr. Chairman.
Okay.
Anything else, Patrick?
No, I think I said my piece.
So how did the slip go and the presentation of the IFC?
Mr. Chairman, Ms. Vice Chairman, it went, it went very well with the asset allocation. This is the first year in our asset allocations that we have not made a change. So now this heavy lifting, it's not like we're going to have 30 new managers going forward. But, you know, the big change, we've gone from a fund of private equities that, you know, so we had one account that had, you know, 20 different funds. Now we have those 20 different funds under their umbrella. All of that heavy lifting has been done. You know, all of the heavy lifting, setting up the internal strategies have been done. So, you know, getting back to your point, you know, the next couple of years, we just want to perform on what you've given us. And again, I just want to thank you for everything that you've done in the support, because it is, without your help, we would be in the hurt box. So thank you very much.
Mr. Chairman,
Go ahead.
last week I was watching the Bloomberg News financial channel, and I looked at it, it says Patrick Fleming, state of Wyoming.
Yep.
Unfortunately, I wasn't able to sit there and watch it because it was scheduled for 2 or 3 o'clock in the afternoon our time. But I wonder if maybe Patrick could give us an update of exactly what he was talking about on Bloomberg for us.
Oh, Mr. Chairman, Senator.
Who's Bloomberg?
Well, first I want to state that kudos to you for watching Bloomberg, because so many people watch CNBC. Institutional investors watch the CNBC and more of the retail, or I'm sorry, Bloomberg, and the retail people look at CNBC. Very, very different. So the Bloomberg presentation, they wanted to know, they have a sector about long-term investors like us, and they said, you know, what are you doing? What are some of the things that you're faced with during these trying times? And I highlighted exactly what I talked to you about, the 1.2% real, just going through these numbers, that states like us that have a 5+ spending policy, or 7% in many instances, if the forecasts are correct, it's not only RBK, they're all saying the same thing, we are going to have a difficult time to meet those on a nominal or after tax or after inflation basis. And so they, that was the gist of the conversation.
Okay. Seeing no further questions? Thanks, Patrick.
Thank you.
What, you got the agenda in front of you? You got it somewhere.
What's that? Yep, we're ready, got the agenda in front of us. So now we're on to, now we're looking at it all comes down now to what we're trying to do is, where do we go from here as far as the things we've been talking about? And, excuse me, so we don't have, I don't think, my recollection was we didn't have anybody from the IFC that was going to be able to attend today. Is Dawn here? Okay, and so we got that, but now, you know, we're back to the kind of the 244 and 220 and the 120, thank you, 121 discussion. And, you know, where do we go from here, particularly in light of the fact that the constitutional amendment did not pass? We've already started to have some discussion about what can we do to start to move in that direction to the extent we can. Again, we may not be able to get into a single fund, but maybe we can get down to, you know, fewer than as many as we have. And so with that, we can either start through that now, but Mr. Treasurer Meyer, you were starting into that today, and we kind of pulled you back. And so we'll come to you first, and then and after that, I think we'll go to Don Patroni if he's on. And
I am here, Mr. Chair.
go ahead, Mr. Treasurer. And just at the outset, this is by way of explanation, I know that we're not 100% agreed on everything that, you know, we've had the 244, we had the report come from the IFC and that. I know that we're not anywhere near 100% agreed on that, but there's significant parts that we are agreed on. And so anyway, go ahead, Mr. Treasurer, we'll turn that over to you.
You bet. Thank you, Mr. Chairman, members of the committee. I guess I'll start with the hammer and go to the olive branch. How's that sound?
Well, however you want to proceed, Mr. Treasurer.
Looking at the Supreme Court case Powers versus Meade, and I think you guys have a copy of that handout that starts as to whom it may concern and parties interested in protecting the Constitution. Essentially, we start with our oath, which is to support, obey, and defend the Constitution of the United States and the Constitution of the state of Wyoming. And that's essentially what we all swear to, legislators, every elected official, county and state. Going into the Powers versus Meade, which as you all probably fondly remember, it's the old 2013 Senate File 104 bill, which stripped a lot of the powers and duties from the superintendent. I had always thought that actually the legislature had a lot more power as prescribed by law. Being a legislator, I kind of leaned that way, even though I didn't necessarily agree with what we were doing. But the first 20 pages of this particular court case pretty much goes into a discussion of the as prescribed by law and what those powers are and necessarily what they're not. And the case actually says that the as described by law is essentially restricted. And it's restricted with an authorization of the Constitution. And I'll draw your attention to the, I guess, I'm not sure if that's citation 20 or paragraph 20. I don't read law, Mr. Chairman and Senator Nethercott. But anyway, on the bottom of page 1, it says the lesson in law and other decisions from this court interpreting Article 5, Section 2 is that the power of the legislature to prescribe by law is not unrestricted. These laws may be enacted that do not interfere with the constitutional or inherent authority of the courts. However, statutes that interfere with that authority are unconstitutional. And the court went on to say that concept is also applicable to constitutionally created executive branch offices. Then it goes on and cites several different precedents from several different jurisdictions. One of the first ones goes clear back to 1845. There was one in Idaho, I believe, and this looks like it's 1940. It says the legislature cannot take from a constitutional officer a portion of the characteristic duties belonging to the office and devolve them upon an officer of its own creation. There's another one here that talks about, a state treasurer, and this is where a state in Minnesota, I guess, created an executive officer or commissioner of finance statutory position. And in that one there, the appellate courts in that jurisdiction have consistently held that the prescribed by law provision does not allow a state legislature to transfer inherent or core functions of executive officers to appointed officials. So, it's fairly clear, and they took about 20 pages. I kind of summarized it in just a few here. But one of the things that I also think is clear is that there is an opportunity for public officials to work with the legislature in areas that we can't agree on, that some people might consider gray areas. And I think where we have those areas that we can agree that there's some things that we need to get done. I'll, say a couple of things that I want to try to get done that necessarily might be considered a little bit gray, but I think if we cooperate, I don't believe we're going to have any legal problems in these areas that I bring up. And one is that I want to address is trying to make sure that we have key man provisions within the Office of the Treasury. In the key man provisions, I guess I would probably define them as salaried positions that start at $250,000 and above. And that would mean the CIO and this new position of the COO. And I think it's extremely important to keep continuity and have some protection for the key men that are within the office. So you have that continuity from one elected official to the next elected official. And that takes some of what I would say the political aspect of the top 5 elected officials out of the picture, as far as whether or not we know that if you get somebody in there that is elected, that has a hard time understanding what should or shouldn't be done, the folks that are running the show don't have to worry about going down the road. And I think if Patrick has told me once, he's probably told me 20 times that people have come to him and said that, yeah, Kurt's thinking about canning you, and we've got an interesting relationship. I'd say that there might be about 6 times that I might have thought about that, but there's probably 26 times that I thought, boy, I ought to take Patrick out him and his wife out for a good steak dinner, because he sure is doing a hell of a job, And so, but I think he'd probably sleep a lot better, and I think that we'd probably have a better relationship if there was some cover in that area. So that's something I'd like to discuss with you guys as far as moving forward and making sure we get done. Then it goes to some of the part of I guess when I look at the aspect of what was put forth here, where the duties of the state treasurer from 1875 clear up into 2020 has been pretty much stripped out of the prospect of the state treasurer's office having much, if anything, to do with them. I really feel that has gone into the level of characteristic duties that have been devolved by the legislative process. It meets that threshold and then some. But I think there's some areas where we can try to find some value and some common ground. Even if this thing moved on and it was the right thing to do at some time, I think this is absolutely the wrong time to do it, when we're just onboarding and getting the accounting system back online and getting it moved forward with all the help that we have, and getting the personnel placed, implemented, and trained to do the job that they should do. Because now we've taken the time to bring in professionals in, identify the problem, get professionals in to actually be part of the solution, and have the positions there to actually And this was described earlier as getting the, not having the tail wag the dog. Because so long, this whole process, we've been moving forward and pushing the investment team and pushing that aspect of it all the time, not paying enough attention to the middle and the back office. And now we've got everybody's attention, we're moving in the right direction, and I think that we don't want to essentially throw this thing into an upheaval and try to figure out, whether or not onboarding these things that has got good momentum, whether that stops them dead in their tracks, which I think that probably would. So I think it's, even if this could be considered and wasn't unconstitutional, this is definitely the wrong time to even think about it. But I do think that there's some things that we can move forward on. I think there's some things and I'm sure that with some good discussion and open dialogue, we could probably come up with more things than what I've put forth. But I think the main thing that is right now is just protecting those key people. There's a few more positions that probably should be going into the mix. And, I say this is from the standpoint that I think whatever we do in these things, when we're making changes, we want to make sure that we actually do add value to the whole system. I don't see a board that is a controlling board rather than an advisory board really adding any value at all. And I'll bring that up back to circle the wagons back around to Florida and Alaska. And over the last 10 years, Florida and Alaska have been the most consistent returning comparators that we've had to look at. And both of those systems have advisory boards. They don't have controlling boards. And both of those systems have elected public officials, more or less in a board structure that could be comparable to our SLIB board. And so there's so many things that align with the most successful investment public firms, if I want to characterize them that way, that in returns that over the last 10 years. And so when I look at what we have right now, I think we're really darn close to some of the firms that have done absolutely the best, if not in America. We modeled the IFC after New Zealand. We modeled the reference portfolio after New Zealand. New Zealand's one of the very top funds in the world. And so we've got a lot of things in our structure and our governance that's quite well. And as fact that the Peterson Institute actually said that we're number one in transparency and governance and other areas in the United States, number 3 in the world. So we're doing things right. It doesn't need a total, complete overhaul. It needs some tweaks, and we need to look at trying to preserve what the successful things that we have, but to make sure that the political process, that's muted, and I think my proposal mutes that. And essentially, the political process hasn't really hurt Alaska. It really hasn't hurt Florida. They've had some hiccups in Alaska where the legislature couldn't get with the governor, and they darn near couldn't make payroll 2 out of the last 5 years. And we don't necessarily have that type of a situation in this area. But I think we can work on some of the areas that we have there, as far as that you have looked at and came up with some, I think, solutions in the area of both in HR and both in the budget process. Florida's got an interesting one. Essentially, what would be necessarily the SLIB board makes up the budget. It's on a basis point, and the legislature is showing that budget, but they can't act on it. Now, the interesting thing about Florida, it's more or less just like our retirement system. It works under federal ERISA. That's where they get their coverage for different things like their tax treatment. So I think that the legislature would have to vote on it in our case because our sovereign wealth fund. You could do this, you could do the Florida model for WRS, probably just right down the line. But I don't think it would work perfectly for Wyoming. But I think those issues of a budget that's tied to the assets under management on a rolling 3-year basis would suffice, would have that oversight. I think perhaps of the SLIB board as far as approval and oversight as far as the IFC on an advisory basis. So that's kind of where I see that we have some common ground. And then I think I explained the legal part where we don't have the common ground, but I think there is that functionality within this particular Supreme Court decision that would allow us to work together on some things. So that's pretty much it, Mr. Chairman.
All right, thank you, Mr. Chairman. Questions for the treasurer? Thank you, Treasurer Meyer. Appreciate your time today.
You bet.
Next, we'll go, Dawn, if you're on there. Dawn, you have something for us?
I'm here, Mr. Chair. Thank you. Yeah, I guess I would just take a moment really to bring everyone kind of back up to speed, if you will, in terms of the materials from the IFC. So just to briefly review where we have come from. Obviously, we were charged with the responsibility to do a significant study, and to somewhat oversimplify, we were basically asked, what would we do to make the investment function a, quote, top tier investment function, and what would it take for us to be embodying the best of practices? And to remind you, we retained RVK, who did an extensive review of peers and their activity amongst a whole series of characteristics. And then we had quite a number of meetings of the IFC with the RVK, really going through aspect by aspect. And within that, we have provided both a written document, I think in mid-November, and on November 30th, Tom Chapman and I spoke to this group. I would point out to this group that in the written materials, we did point out where we had a unanimity of view and where there would be a minority of view. But what I would say is that on all of the points that are being put forward by these presentations, there is a unanimous view of the independent members of the IFC on the recommendation. And we have tried to be forthright where the treasurer, as he's already presented, has taken a differing view so that you can see that balance. The view of the IFC is, since we last presented, is our views are not changed. We continued, in fact, to believe that as you watch these markets and you hear the type of presentation which Patrick did so well, you can see how important it is to provide for a very strong investment capability, a consistency in the approach, an understanding of how to manage risk in what is becoming an increasingly complex world and objectives. The recommendation that we make is that there be established an independent investment for a fund board which would oversee the investment activities. This would be an independent office. It would be a separate legal entity where the SLIB ultimately had the final, in effect, decision on our recommendations of risk and allocation approvals. We would be regularly transparent to both the legislative and the executive branches, and we would look for the legislative branches for the regular review and support on the budgeting. So why do we recommend this? Basically, we feel that the current structure has a series of attendant risks. First of all, we have the risk that in effect in an elected body, the treasurer is an elected person. And so there is a probability of constant change of that person. And there is no assurance that the people that come in as the treasurer will either have the experience or perhaps the talent to be really involved and knowledgeable, not only in investing and risk management, but also all of the underlying infrastructure dynamics and accounting and operations, as you spent considerable time on this morning. That is a big risk because consistency is critically important. The feeling is that this, for example, that employees are looking to know that there's a consistency of their leadership. There is a desire to make sure that you're investing on a long-term basis, that you're making strategic asset allocation types of decisions, which we have raised, which can be maintained for the short term without new people coming in with whatever views they might have and forcing changes that might not be appropriate. We would also point out that we think that having the IFC role formalized will enhance the commitment and the activity that comes from this. At this point, the IFC is an advisory committee. It started out as a committee to advise on fund selection. There's been a natural progression of that role, but there's still no definition really of the role other than as in effect, voluntary advice, which may or may not be accepted. There's an advantage in consistency in budgeting because the decisions that are being made, whether it's staffing or building out technological capabilities, requires that it be a multi-year approach. And then, as I've already indicated, the consistency and stability in the investment style is what's going to lead to enhanced returns. As Patrick pointed out, we have a strategy that can take us through the downturns and the upturns, but you need to have that go on a consistent basis. We believe that this approach is the best practice when you look through the peers across the country, and that will continue to be the truth as complexity grows and your ability to, in a facile way, assess and manage risk. We also, as I indicated, feel the infrastructure is extremely important and integral to this decision. Now, in our materials, we posted a series of steps that we take. Unless it's the desire of this body, I won't go through that right now. I think the most important thing that we would put forward is we continue to stand by our earlier recommendation. Mr. Chair.
Thank you, Don. Appreciate your time and appreciate the members of the IFC and the help that they give us, as well as the advice they give the SLIB and the Treasurer's Office. We appreciate the time and you guys' willingness to share your talent and your expertise. Does everybody have any questions for Mr. O'Patrick? Any questions for Don? Go ahead, Mr. Vice Chair.
So thank you, Mr. Chairman. So Don, just for the folks that it's been a while and we have lots and lots of folks testify in front of us. If you wouldn't mind, could you just walk us through your personal work history and background, and then if you can, briefly a little bit about the other members of the IFC?
Mr. Chair, Mr. Representative, I'd be pleased to. So my background was over 30 years with Goldman Sachs. I was a partner there during the bulk of that period, involved in virtually all aspects of the firm, going from corporate finance, M&A, equities, fixed income, infrastructure, private equity, and ultimately asset management. So that was my history. Since leaving Goldman Sachs, I have continued to be very active. I guess they say A-type personalities die hard. And so I am involved in a number of things. Number one, I am on the mutual fund complex board of a firm, BlackRock. BlackRock manages $11 trillion at this point. And in that capacity, I chair what's referred to as the Performance Oversight Committee, which in effect assesses how every fund is doing in the course of its performance and risks and the general environment. So that's a considerable activity. I was the vice chair of Cornell University on that board for 15 years and chaired the investment committee there. That was a complete turnaround where we moved it from New York. Basically, I replaced all the operations, replaced most of the people, and frankly, most of the investment committee. And last year, they reported a 44.6% return on that endowment. Other areas I chair, I'm the vice chair and chair the investment committee for the Arizona Community Foundation, which is about $2 billion. I also, at another extreme scale, am on the executive committee and chair the investment activities for the Jackson Hole Community Foundation. So from one extreme to the other. So I continue to be very active in investing. Obviously, I invest myself. So much as my wife may complain about it, I stay quite busy within all these activities. I was recently elected to be the chair of the board of the Phoenix Art Museum as well, and I'm on that investment committee as well. So that's a little synopsis of things that I do. In terms of the makeup of the IFC, we really have a broad experience range. We've had some that have been more involved, some more recently. So let me see if I can get all of this right. Tom Chapman, who is the former vice chair, I currently serve as the vice chair, the chair being the treasurer, came up really through the hedge fund, worked with Robertson's firm, has since involved himself in both a number of boards, but also a lot of activity investing in Wyoming and in around Jackson in terms of a number of family investments in which they're involved. Ken Lay was the treasurer of the World Bank. So obviously oversaw things like the pension fund there, but also brings kind of a strong world view, politic world, geopolitical interpretation to what we do, as well as having seen a lot of sovereign wealth. And he continues to be on several investment funds where they do what's referred to as OCIO, or Outside Chief Investment Officer. Let's see, we have Russell, who has been the Chief Investment Officer for Alaska, which the treasurer had mentioned, which, by the way, facing some challenges in their structure, and is also quite active right now in Abu Dhabi. So he sees a completely different perspective, but once again, in the context of sovereign wealth, particularly with a bit of a leaning towards what I would refer to as an endowment structure. Let's see, who else do we have? We have Dick.
Grannis.
Was the treasurer of the tech business, has been very active in cash management, is very focused on structural dynamic operations and the like. And then we have two more recent additions, Cecilia Herbert, who has been involved in banking historically, more recently in investing. She is also involved with BlackRock in their fixed income board. The area I'm in is much more of the equity, or hers is more money market and ours is fixed income. And then we have a gentleman, Drew, who I apologize, I don't have all the last surnames in front of me. Drew recently joined, and he has been in the hedge fund industry and currently runs his own hedge fund as well.
I think you mean Doug Dillard.
Doug Dillard, thank you.
Yeah.
Doug and Cecilia joined us within the last months or so. So the group has been growing. It is diverse. And frankly, I think it works remarkably well together at this point.
Well, and Mr. Chairman, as the liaison to the IFC, I can just tell you that it's just amazing to sit in and to listen to the discussions that take place in these committees, and the caliber of talent that have volunteered to do this work for the state of Wyoming is absolutely tremendous. And Don has kind of been the leader of the pack of this group. And Don, just thank you so much for your time and effort. It's just amazing that we have the gift of your services and making Wyoming a better place to live. So thank you.
Thank you, Mr. Representative.
Thank you. All right. Any other questions or requests of Mr. O'Patterney? Right. Thank you, Don. Appreciate your time today. Did you have something, Mr. Treasurer?
Pleasure, thank you.
And Don, please don't think or characterize my opposition to this as a opposition to the IFC. I think you folks do the state a great service, and you're definitely a talented group of individuals. But Mr. Chairman, I guess I kind of look at the facts that we've seen is that, and this is a question that I asked RVK, is whether there was any study that actually shows a correlation between investment firms taken over and managed by a governance structure as proposed or versus one that is one that's advisory. And there's no study that shows any correlation of better returns. In fact, the study that we did in our office basically proves that as far as the historical fund performance, and you guys have it, between whether something is accountable or more independent, that there's no correlation between what you're actually going to make. So, Mr. Chairman, I would hope that you guys would support, obey, and defend our Constitution, that you would honor your oath, and that we can work together to continue the success that we've had. We've had a very, very good success in the last 3 years. We're moving from 20 billion to 25 billion, to adding several hundred basis points in excess returns. We've done that in a cooperative fashion between the legislature, the IFC, and the SLIB board. I think we've got great leadership that's in our office and in all areas, and we're moving in the right direction. I think that if we move forward with this plan as it's envisioned, that we're going to be going one step forward and 5 steps back. Thank you.
All right, thank you, Mr. Treasurer. Why don't we, it's 3:12, why don't we take a short break and we'll come back, and then I think what I want to do when we come back is, why don't we take a minute and what I was thinking we would do, Ian, is why don't you take us through kind of some of our charges. We've got, there's some outlines, some other stuff, but what I want to do is take a minute and review the stuff that we're supposed to accomplish this interim. And let's have some discussion among the committee about where we want to go and how we want to undertake some of that. I know we've got to undertake the cash budgeting study. I want to visit about that a little bit and where we go on that, and we'll use the rest of the time we have today to kind of outline where we go and see if we can get some direction about how we move forward for the remainder of the interim.
Mr. Chair,
Yes, go
before
ahead, Mr.
before we
Vice
do that, I just want to make a couple comments. So one of the issues, obviously, that will be important for us to address is the suggestion that perhaps continuing to work on House Bill 244 has some type of a constitutional prohibitive concept to it. So I've asked LSO to put together a research paper and a brief on that. That's still in the process of being written. Because we need, it's been raised by the treasurer, and so we need to know and have the best legal minds we can talk about that, because we don't want that to be a continual burr under the saddle on how we proceed and what that process is going to be. But I can say that, Mr. Chairman, that, obviously, there's a few lawyers on this board, on this committee. We have looked at this issue, and I have spent considerable amount of time researching this issue. And I can say, with my personal belief, which will be, we'll address that when the LSO comes out with its report. But I would say that almost the exact opposite is the truth. That being that this has nothing to do with impinging in any way on the treasurer's inherent authority or what his job has been in the past. And in fact, in the 1990s, the State Lands Office controlled the investments that were administered as part of our permanent investment funds. That's how recently and since then, we've gone from bonds and direct types of investments to managing a highly sophisticated investment funds. And never in the history prior to the 1990s had the treasurer ever assumed any type of responsibilities like that. So to say that there are inherent powers to do it, I think is a misnomer. But we'll walk through all those issues. But I think it's important that we all think about that independently, and we all kind of reach our own conclusions on that as we move forward, because that will, it's a roadblock in front of us, and it's going to be behind us. And it's important that we all do our own independent research and thinking on this issue as we move forward. So appreciate it.
All right, so we'll come back. We'll come back at 3:30.
although apparently the cameras do work.
You want us, okay, well, that just makes you like the size of Oz.
Well,
but,
it
yeah.
could be, the only reason is
Fact-
that we can type your instructions a lot better and tag team.
For some reason, when Gru was on there today, all I could think of was the Wizard of Oz and the big Oz face. By the curtain.
What was that behind? Don't pay no attention to that man behind the curtain.
Oh, speaking of which, hey, it's the great and powerful Oz. How are you doing?
Yeah, well, better than the guy in Pennsylvania, but 10 to a point better or worse. I'm a good.
Well, I can tell you this much. I know you're not outside the Senate chamber. I was just up there.
No, I was just grabbing a copy of the Constitution, reading what my duties were. I didn't quite get all of it before. I just kind of chimed on and caught the last bit of the last meeting. So I'm
Okay.
on that.
All right, well, thank you. All right, so we'll go ahead and pull us back to order. So again, what we're going to try and do the rest of the day is kind of visit with staff, give them some marching orders, kind of get folks outlined get staff outlined for next meeting and also kind of get everybody clued back in about where we're going and the stuff we've got to do this year. Also remind you should have out. Now, some people are not paying attention, and if you don't get paid your per diem, you'll wonder why. Don't forget to turn in your travel reimbursement forms, get those in. And with that, we're gonna go over here, and they work better behind the desk over there. So, Ian, we'll turn this over to you. We talked a little bit about, why don't you go ahead and take us through kind of where we are, what help, what direction you need from us, and also, to some extent, I know that you and I and the vice chair have talked, and we've got some things outlined, some of the topics outlined for the rest of the year, and if you can take us through that, we'd appreciate it. So turn time over to you. Thanks, Ian.
Very good, Mr. Chairman. Thank you. Appreciate it. And if it doesn't work at this table, if the cameras don't get us, et cetera, we can move to the main one. But for now, we'll try this. I think it'll work a little bit better for our team
You
to
pull
make
the
sure.
mic a little bit closer and slow down just a little bit.
Okay, it's probably better. Okay, the first thing I'll do for the committee is simply refer to our interim topics so that we kind of get a general idea of what our charge is for this interim. There were 7 topics total, although some of them I think that are related and can be combined in one effort. The first of those topics was continuation of the House Bill 244 study. That refers specifically to a lot of what has been discussed today. The RVK and IFC report that was just discussed were a result of that 244 study. It requires a study of the investment management structure at the Treasurer's office and changes that could be made. A second of all is a continued study under Senate File 121. Now, that also relates to investment structure, but is more in terms of the legal nature of our permanent and non-permanent funds and what might be able to be done to increase both the allocation of earnings from those various funds, as well as structures that prevent appropriate investment of those funds. So those are 2 items, of course, that took up a considerable amount of time last interim. We have a number 3 on our interim topic list is our statutory responsibilities. These are reports for things like the spending policies and performance compensation, our standard duties. A lot of those can be done towards the end of the interim. Number 4 is impediments to an investment performance. I think this could involve a lot of different things, but one thing in his office is things like public purpose investments, income-focused investment procedures, the structure of the reserve accounts, and the fact that they need to be funded and the impact that has on our ability to make other investment decisions, and loans and backstops that also exist in our statutory or constitutional structure, and how that impacts our ability to make freer investment decisions. Number 5, this was a topic that was brought to us by the State Treasurer's Office, and it's changes to the selection panel for the Investment Funds Committee. Some fairly obvious things like chairmanship, and that should also be an issue that will be relatively easy to handle in one meeting, maybe, and towards the end of the interim. Number 6 is a study on performance compensation. That has a lot of different facets, but and we haven't determined a timing for that topic either. And then finally, number 7 is cash-based budgeting. That is a topic that will need some, that has been considered, as I think you all recall, there was a bill last year that wasn't passed or didn't go far, but that kind of outlines the structure for that. I believe Speaker Barlow was interested in that and sponsored that legislation, and could be someone who could talk to this committee. Our budget fiscal folks have been invested in this topic and have been looking into it for some time, and I think are prepared to, at maybe the July meeting and then certainly in the August meeting, to provide some information on that. So with that, those are our 7 interim topics that we have to deal with in some level of detail. So I guess the first thing I might do is go to the top and have Brian Fuller talk to you a little bit about the House Bill 244 study. Brian has already put a lot of effort into that study. He's looked at both the RVK report and then the IFC's report. And I'll let him talk a little bit about that in terms of what we might be able to accomplish and get some direction from the committee.
Brian?
Yeah, so Mr. Chairman, Brian Fuller, LSO. The material, I believe it's 6-01, it's the memorandum that just summarized House Bill 244. And I would just note, beginning on the bottom of page 7, is a basic outline of a potential bill draft that would track with the recommendations in the IFC report that was submitted last November. Within this outline would be a number of decision points for the select committee, some of which are interrelated. So for example, the resources that would be allocated to a new board would depend on what investment duties would be given to this new board in terms of the accounts. So put more simply, what accounts or what funds are assigned to this new board? That list is on pages 9, 10, and 11. That just identifies the various places in statute where the legislature has directed the treasurer currently to invest those funds. Beyond that, I think the big decision points would revolve around the transition to a new board or a new investment department, the timing for that, the method of transfer, how things are handled in the interim during this transfer. Another area would be responsibility for loans using state funds that are currently allocated to other agencies or the treasurer SLIB, and those are on the top of page 9. And then finally, Mr. Chairman, a couple of just broader observations. First, how the select committee would tackle that topic number 5. So the changes to the existing panel may well depend on how the select committee proceeds here. If it proceeds, in accordance with the IFC recommendations, then amending those current statutes for the selection panel, may not align with, the bill draft as at least the IFC has contemplated that. And then second, and more broadly, certainly, there's been discussion about, the scope of how to proceed, and that is entirely within the select committee's purview to decide if they want to create new entities. If so, what duties those entities should have, what powers, the composition of a board or department. Mr. Chairman, with that, I would stand for questions.
Okay, thank you. Let me, Brian, one question I have is as we looked, I think that the way I see this, I don't know, this breaks down into a number of different component parts, but there's some significant interrelation. For example, the structure, but particularly if you look at item 2 on the 121 study, the impediments to performance, which is item number 4, you look at those two together, and I mean, there's some significant overlap in there, isn't there? And that's a,
Mr. Chairman, I'm trying to follow along with you. Where are you?
well, I'm looking back at this memorandum.
May 3 from Brian Fuller?
Yeah, well, there's a March 24, it's actually a memorandum from me dated March 24, and I don't, did that get distributed? I don't know if we have that distributed. Did we distribute it out, Paulie? This is that memorandum from May 24?
No, Mr. Chairman, that has not been
Okay.
recently distributed, but I can email it to you all right
Okay,
here.
so what it was Ian went through a number of those things, but going back to 244, I was talking with my co-chairman, vice chairman, and he had is this one of the areas that you were thinking about? It might be helpful if we had a work group, started on this?
Yes, I believe so.
Okay, do you have any suggestions about what that work group looks like and what it ought to be looking at in this interim?
Well, I think one of the first low-hanging fruit we should look at is reviewing the multiple funds out there and what we can condense or eliminate or remove and or combine, so that we take our some 400 funds and just start compressing to the extent possible. Working with LSO and also I think with probably someone from the treasurer's office, so we have the right understanding of how to go about it, where to do it, statutory changes, and just start working our way down through it. So that would be number one.
Okay, and in there, would you take the legislative investments as a part of that? The legislative direct LDIs, the legislative directed investments as a part of that?
Correct.
Okay. Would you, and Mr. Treasurer, I think your office has interest in that. Is that correct? I mean, trying to get this thing streamlined down to where we're trying to get, maybe we can't get it to one fund, but maybe we can get it down to a half a dozen or 10 or something. I mean, wouldn't that be a vast improvement?
I think a lot of it is cash management, but I think when you start thinking about removing some of those funds, remember that the reason we've got all of them, because there's a constituency, I guess, on every one of them. But what we want to try to do when you correlate something, necessarily not to remove that constituency, but to remove the impediments about the way that it's invested.
Right, they still get everything just becomes proportional, so they get, when there's a distribution, they just get their proportional share of the distribution. We're not accounting, but they're just, everybody's in and they just share like
I think this
stock in something. Isn't that what we're talking about?
The simplest ones, I think, is to identify it in two different ways. Ones that don't have the income restriction, and put all of those on one side, because there you can do a fairly simple proportional distribution there. And if you have different funds that go in and out of them as far as distributions to those funds to be invested, that's fairly easy to maintain.
Right.
But when you start getting into where you have that income problem, even if you put funds that you can invest the same way, you still have to break it down into those constituent things as far as the different color of the income. And that's so you don't gain too much efficiencies in accounting, but you will gain some in the areas of investing.
Right, and so that's what I think that's what we're talking about is getting a working group together to start to work on that and figure out what those groupings ought to look like. I know you guys have done some work on that, I believe, but start to get that, and then we figure out what are the statutory impediments to doing some of those, so that we as a committee can take that, attack that side. But I think that's kind of what you had envisioned, isn't it?
Yeah, and I think that would also dovetail into looking at the public purpose restrictions and figuring out if there's ways we can direct those. We can, right now we're tying up $800 million and we don't need to do that. We just don't. And there are different ways. Yeah. Well, they're not all bad, but then the question is, what should we tie up? It may make more sense to tie up a reserve account or some other entity versus what we're currently tying up and put caps on it that require legislative approval to expand it. Just once again, to circle the wagons on having the most efficient way to manage our money and make the most money. Because as Patrick said, we're going to be in a 1 to 2%, 1 to 1.5% total return on our investments in the future if we don't find a better way to do it. And it'll be an ugly 10 years if that's the case. So, particularly if we have a recession and all oil and gas drop.
Mr. Chairman, just
Go ahead.
as part of that conversation, I think it would be interesting to contemplate the amount of work that might go into each of those elements. I think you're right in that they're the same. I mean, they're so related, and I think they're certainly both related, you could say, to that Senate File 121 study. But I would suggest a single working group may have a lot if they have to consider out what funds can be consolidated with consideration of all the beneficiary obligations and, what other obligations exist on the various funds where they're dragging them down, PPIs, legislative directed investments, et cetera. Might be two very large issues, even though they're related.
Piece of cake.
Piece of cake.
Okay. All right, so does anybody have interest in serving on that committee? On that, working group? Okay.
Mr. Chairman, I don't know that it would be in this working group, and maybe I'm getting ahead 121, but in light of those constitutional amendments that were not successful last year that we want to make a run at, I think we ought to have another meetings to bring those up. But I think a real study of the size of the reserve account and then how we can move that inside the same square and do this accounting piece we're talking about, not invest that differently. I mean, that's what we're talking about bringing. So I think this reserve account piece has got to be, it's one of the big funds, right? It's like $800 million right now. And then I think also a little bit, and I know Mr. Groover's done some of this in the past, what is the corpus? Go in and look and do a definition of all these deposits, earnings, and what actually is the corpus. Can some of that be segregated to make a bigger reserve fund? And then finally, I think, and this a lot of appropriators on this, we always did 4-year profiles. And now we've moved to this 6-year profile in a state with the third most volatile revenue in the United States. And I think we got to have this discussion. If we want to do 6-year profiles, and
I think at the end of the day, I think it depends on the size of your reserve account. If your reserve account for 6 years, it doesn't matter.
That's exactly where I'm going with this. Yeah. So if it's going to stay 6, then it's going to be a bigger reserve account. But if they're all invested the same, that's probably fine. But I think you got to have that discussion. So again, and I think this happened in the last couple of years. Not all of us. I wasn't on ProPSIN, and I think this whole 6-year thing gets pretty dicey. And anyway, I just think reserve accounts are part of that corpus definition. Thank you.
Okay.
Mr. Chairman.
Go ahead.
I'm still trying to catch up with you. You started referencing a memo that we've not seen, but you started talking about an overlap between 121 and 244. And I was trying to follow where you were going with that and how that relates to the working group, or have you abandoned that thought?
No, I probably have misspoken, because if we do what we're talking about, this group has all the work it can do.
Okay, all right, I'm following you now.
So yes.
Mr. Chairman, can I make one other thing clear? The memo actually is just a reflection of the interim topics. So the memo just doesn't include anything more than those, other than a quick summary of what that topic is about, just so that we're all on the same page.
Yeah, and I think they've just sent this out to you. This was a memorandum that we sent to Management Council, or to Management Council, about our proposed interim topics, and they were approved. That's after we had our meeting, and we had our joint meeting, we proposed these things. It was what we had sent that put all those things off. So the vice chairman and I had we've worked with staff, we've kind of outlined our meeting, kind of our meeting schedule, which ones we want to work on at what point in time. And so I apologize for that, but I think Polly has now sent that out to everybody. So everybody's got a copy of that memorandum now. It has the 7 topics, that Management Council asked us to look at. Okay, so we're back to our study group as expanded. So anyway, folks, let's just start with that what happens is the management, as the working group starts out, if it ends up that it's too much, or something, you just need to let us know and we'll expand or we'll divide or we'll pare down or whatever it is we're gonna do. But we will, we'll look, this stuff's gotta get looked at sooner or later. Gonna move in that direction.
Mr. Co-Chair, I'd be happy to chair that group and orchestrate it, so, because it's what I like to do.
Okay.
And Larry had his hand up.
Okay, so, and you also, Representative Obermueller? No, I think if you could get 4, that would be ideal. 1, 2, Larry and Bob and Andy. Andy.
Bipartisan.
Yeah.
Next meeting?
He's a short timer, so we might as well use him like a bad
He's got 9 days left to file.
I've been practicing his signature.
All right.
You should do it online right now.
So, Mr. Chairman, I suggest that we have at least one is this a subcommittee meeting or?
We're calling a working group.
Important distinction.
Well, Mr. Vice President, do you have a preference since you're on leadership, or management council?
I would prefer it's a subcommittee because I think this would be significant.
Work,
Mr. Chairman,
Yes.
that's good. Subcommittees have certain requirements under the rules. So although I think we do have split membership, so that's important, but a subcommittee then under the standard rules will require a report from the subcommittee to the regular committee towards the end of your work. That doesn't mean you have to have minutes for every meeting. It's just a more formalized process. So you know.
We'll report. It's easy.
Okay. All right. So we'll do that.
Mr. Chairman, that means you would like to have a subcommittee. Is that correct?
That's I take my lead from my leadership, and my leadership said you'd like a subcommittee, so I say yes, sir. Okay, great. And then with respect to there's times on the other thing I wanted to make sure we had a visit about was selection panel investment funds committee. We've got I think there's some work. I think Mr. Treasurer, I think you guys had talked to us. Was it you that came and talked to us about this? Yeah. Right. Good morning or afternoon.
Good afternoon, members, Chairman, Matt Saget, Treasurer's Office. I think through the selection panel process last year with the nomination and appointment of Doug Dillard and Cecilia Herbert, there were a few items that came up, and in IFC's deliberation on selection panel and how that worked, this was kind of modeled off of New Zealand's double-blind process. But there'll probably just be a few minor tweaks to the selection process, and maybe timeline on reappointment of a selection panel member, maybe some restrictions on selection panel members running for the IFC. That created some some issues within the process last time. So I don't think it would be a lot of work and
Matt, were there
So
any-
do we need an extra group? Or do you think that's something you can come present to us at a meeting and we can work through it? Think that's
Mr.
okay?
Chairman, yeah, it'd be relatively short, I think.
Okay, and then the other one that we wanted to look at was performance compensation. Now that we've had a chance, we've kind of had the first accrual of a performance compensation. You know what it is. You know, you've got this accrual that comes up that we set up, it was there before. We just wanted to take a look at, it to see if it's working the way that we thought it would work, if it needs a tweak. I mean, it's just now that we've kind of done it the first time, is there any lessons to be learned or anything that needs to be changed? Or if it's working perfectly, that's great too. We just wanted to come back and visit that now that we've got some experience. We have at least the first time experience with it.
Yeah, I think there's some things there that in HR that we'd like to talk about. And one of them is in the investment area, moving some of the folks forward into higher paying positions, because I mean, their wages are going up. You know, you heard about accountants, investment people's wages are going up probably faster or you know, with a lot more dollars in different areas. So we need to have that discussion. The other discussion I'd like to have is maybe bring the HR person from WCDA and give a report about what they do in their performance. They're an instrumentality. They've got their own performance pay system that they set up. They've got some very non-subjective areas that they're judged on, and there's a pool that's available to all of the employees. But I think that would be a good exercise of you guys getting a cursory understanding about something that's been working for quite some time and working well. And
We're more than happy to
Yeah.
compare and contrast.
Yeah.
So we're always happy to do that. Good idea.
So, Mr. Co-Chair, I mean, we've had some discussions about how and if we should provide additional compensation for middle office folks. The issue obviously would be that you'll have a segregation then within your office of higher paying positions, which people will want to gravitate to. So that will create an unbalance to some degree, and the pros and cons of that. My thinking on that really is, I would suggest that we just put that on the agenda and let the treasurer come and present what he would like to us, instead of us doing any.
I think that's exactly
Right.
what we're talking
Right,
about.
and
so.
you're not talking about huge things on middle office. You're talking about a pool for the accounting and those folks are probably a couple $100,000. And so it's not like you're giving them, you know, $50,000 a piece perks or $20,000 a piece perks. You know, it's more of things that necessarily it's enough to give them an incentive, you know, to follow the guidelines, but not so much to break the bank.
No, you're gonna revise and extend your remarks through your attorney? Okay.
Mr. Chairman, Lisa Jurdy Spillman, General Counsel for the State Treasurer's Office. When our office made the request for this to be an interim topic, we were reviewing a variety of salary structures of investment funds, sovereign funds across the U.S., pension funds, as well as investment firms. And frankly, we're lower than the bottom 25% across the board, like way lower than the bottom 25% in terms of salary structure for the middle and back office, and probably also with investment staff. But so what the request was to review what the salary structure should be for a sovereign wealth fund that manages $25 billion and try to bring the investment division and the office to those levels. That was kind of the idea. That is how we drafted it. And alongside that idea was potentially performance comp across the lot of us, but more trying to look at, you know, what are investment counsel earning in the private market? What are accountants earning in, you know, and in Alaska? That conversation.
Look forward to it. All right.
Mr.
then-
Chairman, I'm just wondering, do you want to assign those topics, like the selection panel suggestions to change and that performance computation to a specific meeting, like July or August?
Yeah, how far along are you with that? How far along are you with that process? Would you be prepared to present in July?
Yes, Mr. Chairman, I provided alongside the interim topic 2 studies. One was conducted by Texas Pension Fund, and the other was, Patrick, what's the name of, the McLaughlin study? So I attached both of those studies to the interim topic, so we would be
You and Patrick
prepared.
are telekinetic. You guys you just looked at him, he didn't move his mouth, and you came up with the answer.
That's right.
Amazing.
We're a good team. Thank you.
Okay. All right, great, thank you. Then cash-based budgeting, on that, I think, so Don Richards is doing a little bit of a deep dive on that, and he's got a number of time commitments. So Don is asked to present in our August meeting at the Treasurers Conference. We'll accommodate that, but what we'll do in our July meeting is we'll have Polly kind of give us the primer on it and get us kind of lined out if we're not aware of that. You guys, I think you guys in the House have had this discussion a few times, but I don't think this discussion's ever been very deep in the Senate. So if you guys don't need it, I believe that the Senate side at least needs a primer on that if we're going to understand what Don talks about in August. So we'll probably look for that primer in our July meeting. And then what we'll do on the, and then we'll continue our discussion with the treasurer, and we'll try and concentrate on our 244 reports. There are significant things that we agree on. There's some things, very significant things we don't have a disagreement on, but we'll move forward on at least the things that we agree on and continue to work on that. Mr. Treasurer, that's okay with you?
Yeah, Mr. Chairman, I'd like a crack at 121 language and have it start in the Senate this year. Just, you know, I think you can get that passed, and really would like to have Josh at RVK, you know, work with the legislature on that if we can talk him into it.
If we'll consider, obviously the language we had last year didn't work, so.
Yeah.
If there's other language where I will look at any good suggestions that come along.
Yeah, I think Josh has got some good principles that the language that we had last year just really doesn't quite adhere to, and I think if we follow those principles and take some of his leadership, we might be able to get something that could pass pass both bodies and potentially, you know, have a good run out in the public.
Okay. I think that gets us pretty much through our list of topics. What else do you need from us, staff?
No, Mr. Chairman, I think that's probably it. Obviously, we'll need to get some better definition for the 121 study, which is the big topics, but we can do that in the working group, or I'm sorry, the subcommittee, and go from there. So,
okay.
Yeah. I mean, is there anything else that you guys can think of? Yeah, Mr. Chairman, I guess the only other question is whether you'd want anything else for the 244 study what I just wrote down was try to come up with an idea of what we agree on, what we don't agree on in terms of what the treasurer's office was want. Is there anything else that you can think of there?
Not at this point. I think if we just define those things that we agree on, and those that we don't agree on, and then, you know, we'll obviously try and move forward on the things we agree on, and we'll see if we can find a compromise or a way to work through the things we don't agree on. That's how we do it, right? Yes, go ahead.
No, just one thing maybe for this heard it early today was time serious timing issue, cash flow with the Apple, you know. And investors, we have to make those payments out to colleges in August, don't get the returns. We had a bill, I think halfway with that bill also increased scholarships that failed. We had that piece to fix that right pocket, left pocket, right pocket. And so I think that's an important piece of this timing thing. That's a little paragraph. It's already written. That needs to probably get accomplished.
Well, you have a subcommittee member on each side of you. Make sure you, or excuse me, yes. He's already got it.
Mr. Chairman, is that the one that came out of school?
I think it did come out of education.
No, it didn't come out of the select committee on school. Is that, there's one that came out of select committee that was a timing issue, and I thought that was the one. It failed, that we got back in JEC issue.
Joint Education Committee bill that is all that. I can't remember now, but it's a
I
timing.
think he's talking about construction you're talking about. I just want to make sure it wasn't getting, I think
No.
you're
I'm
talking
talking
about.
about Apple. Yeah, I'm talking about the Apple.
It'd be okay if you could make one or two less distributions, wouldn't it? Or movements of money, just to move. So anyway, see if we can, yeah. Well, lighten your workload by lighten your workload by 0.0001%. Got to start somewhere.
Well, I think it's better transparency.
Yeah, it is. No, that's, okay. With that, is there anything else from any members of the committee? Anything else from any members of the committee? Nope. All right. Thank you for your time.